guys, we're going to look at Skechers. Skechers usually has a very, very big move on earnings and then just kind of sits there. Usually expected over 10%, usually 10, 12% expected move. Okay, here's the chart. Obviously, this thing has just rallied tremendously since the December massacre. Okay, we're kind of in the middle of no man's land here. Actually, not kind of. We really are in the middle of no man's land here. With a big potential gap to fill on the upside. And the stock coming off, you know, a couple of decent, or one decent earnings report here. And then just kind of flatlining. That's not a very big upgrade, right? We're talking about, you know, less than 5% or, you know, 5 to 8% above the market. That's not a real big upgrade, but yes, I saw that. Okay, so here's the chart on Skechers. Okay, what is the expected move here? Okay, about 4.25. Okay, so that gives us stock price. I forgot to put up here. Stock is 35.25. So that puts us at an expected range of 31 up to like 39.5. Okay, going back to the chart here. Well, that 31 area is really, really big support. Really big support in the stock. And that's because you have here, it was resistance here, it was resistance here, and you can obviously see that pattern there. 39 on the upside. Not a ton of resistance there. It's in the middle, still up to that gap zone. I would say there's actually more resistance here around 38.25, so not far from that. But this old support right here will be the next line of resistance. Okay, so good support 31 and resistance 38.5. Okay, I look at this chart. I know we talked about being, you know, on the show bearish. Okay, I don't know. I just know that there's going to be a big move here. Let's see what volatility is doing. Okay. So, if we look for just the 1 day iron condor here, yeah, this isn't going to line. These markets are pretty messed up here. Okay, so if we looked at this, what's wrong with this market on the screen here, guys? What's wrong with this market on the screen? Okay, crazy wide. And if you just go to that, midpoint or mark, which everybody likes to do, talk to me about that. Okay, talk to me about why that's not real. The mark, the midpoint, the theoretical value here. Well, no, Larry, it's not a matter of don't trust, but why, or let's put it this way, why can't you trust this market? What's wrong with it? Vol is irrelevant. All we're focused in, all my question is, this market right here, with a midpoint mark theoretical value of whatever you want to talk about being 80 cents, why is that not real? Why is that not real? Okay, bid, yes, we know that the bids and the offers are very, very wide. Okay, but you look at that and say, okay, 85 cents is the mark. That's where I should be able to trade it, right? Well, it should be negative, Mike, because we're selling it. So the negative is right. But the question is, guys, why would this never trade 80 or 85 cents here? Okay, think about it, guys. Think about it. Come on. I'm not giving you the answer. I'm seeing this one as a little bit too obvious. Well, it is in the middle. Bob, that is right in the middle. That 87 cents is directly in the middle of this market. But why is that not real? Come on, guys. Come on. I'm disappointed here. Doesn't matter what IV shows. Doesn't matter. Why would this never trade at 85 cents here, guys? And what should this trade at? You tell me. You know. You definitely know. I'm going to keep going until I get more answers here, guys. I'm going to let you guys keep answering here. The 32.31 and 38.39 iron condor is showing a midpoint of 80 cents. Will this ever trade 80 cents with the stock here? Okay, guys, what is the break even? The break even of this iron condor would be 31.20 up to 38.80. Right? Being able to sell this at 80 cents? Well, Eric, I wouldn't say never, but you're definitely on to something. Okay, I wouldn't say never, but you are definitely on to something. Okay? We always look to compare break even to the expected range, right? Right? No, Rob, it's not 38.20 because we're collecting 80 cents on this thing. So it's the short strike plus or minus 80 cents. Okay? If these break-evens were on both sides really close to the expected range, and we're there on the downside, a little bit further away on the upside, but if we were really close to the expected range, what would this thing be trading for? What do we look for? No, not more, Teresa. What do we look for in our reward to risk on a credit spread like an iron condor, guys? What kind of reward to risk? Bingo, 1-to-1. So if we were looking for 1-to-1 reward to risk, then this would trade theoretically 50 cents, right? Okay, so there's no way, zero chance, did I say zero? That this thing is going to trade 80 cents. The arbitrage, the opportunity, the market would not let this get out of line like that. To have such minimal amount of risk. Right? To risk 20 cents to make 80 cents. So there's no chance that could be trading there. This probably, however, is trading somewhere around 50 cents. Okay. Lionel, I think you made a very good point. Let me go back up in the notes. Yes. Lionel, you still there? Because you made a very good point on this. Lionel said, let me go back and quote him exactly, it's higher than the ask. What I think you meant to say, and you can correct me if I'm wrong, Lionel, is that the ask on this market is at $1.45. Well, what is the maximum value? No matter where this stock goes, what is the maximum value this thing could ever trade? Yes, Gary's got it, Mick's got it, $1. Could never trade more than $1, no matter what. No matter what. Whether the stock went to 0 or 100. So if we look at it that way, the real market then, or at least a more accurate market, would be Zero bid, offered at $1. Okay? And this obviously is going to trade higher than zero, but let's say it's even zero. That stays zero. It can't trade for more than $1. Well, now if you just look at it that way, now our midpoint is down to 50 cents. Again, can't always go by that midpoint or theoretical or mark, whatever you want to call it. However, that obviously gets us into a much more accurate zone. Does that make sense? Okay, so now that we've got that out of the way, let's get back to evaluating if we want to do something here. Well, Gary, what I think it takes is just a basic understanding of option theory, right? Again, you have a $1 spread here. So just knowing that it could never be more than $1 makes this market, theoretical market out there, bogus. How many would I sell at 75 or 80 cents here? Probably as many as they'd let me. Okay, however, the iron condor is not going to work for us. Because even if we sold it at, probably the 50 cents that we could sell it at, which is not horrendous. 50 cents gives us that 1-to-1 reward to risk, but on these strikes, that would not get us to the break-evens. So what else should we look at? Okay, so Paul, we would look at a vertical call spread if what? There you go, Gary. Yeah, we would look at a vertical call spread if we're bullish. I mean, I'm pretty neutral here based on the technicals. Okay, so calendar, Shane, but calendar what? What direction? Or do we not care about direction? There you go, Alan. You can look at a strangle swap, which is all going to depend on what is volatility doing. Right? Strangle swap, easy for me to say, really is going to come down to where is volatility trading. So let's go right to the strikes we're looking at. 31 on the downside and 39 on the upside. In fact, what I want to do is, because we're close to the even strikes of 30 and 40, let's start there, because that's going to give us the highest amount of open interest. And then we can kind of work our way in from there. So let's say we did even a 1 month. Let's go 1 month. Let's give ourselves some time on this and see how this looks. And I'm going to tell you this will not look good based on the volatility that I'm using, which means we may want to shorten this up a little bit, but let's take a look. Okay, a 1 month strangle swap here is going to cost us probably 70 cents. Okay, this is what this looks like tomorrow in a best case scenario. So, I don't like it. Now, it also does give us the ability to sell more premium if tomorrow comes off, but I don't like that at all. So, rather than looking at 1 month, let's look at 1 week. First off, this probably costs us 50 cents. That doesn't look so good either. Remember, I'm adjusting volatilities here to see what this would look like going forward. I don't like it. Okay, let's just look at a 1 week calendar put spread. Okay, that probably costs 20 cents. That's not horrendous. But that's just one side of the ledger, right? That's just one side of the ledger. And, you know, looking at the charts, if I'm, you know, kind of undetermined, like URI, definitely bearish. If I'm kind of undetermined from looking at the charts here, I don't want to just throw something out on one side of the ledger, meaning one, you know, either put or call, and hope for the best. So, what am I trying to say here in Skechers? Anyone? After all this evaluation, what am I trying to say here? Bingo. Not going to try and force a trade, guys. Just not going to do it. Wait for a rainy day. You know, and I'll tell you what something that I will be prepared to do if Skechers drops to this 31-ish area again, I will absolutely be ready to put on some sort of long spread, whether it's selling a put spread, buying a call spread. And likewise, if it gets up even beyond this area of resistance here that I thought and gets up to fill this gap at 41, I'd be willing to short it up there as well. So we'll keep Skechers up on the watch list for a possible post-earnings trade. How does that sound? Okay. All right. Let me post this up there, get the video up here, and I'll be right back, guys.